Welcome everyone to this session for It Depends. Every other month, we like to have a session where we talk to Tony about specific topics that can help us with saving our taxes, and then we'll follow it by Q&A. So for this week's session, we're going to be talking about small business hacks and how you can utilize starting a small business to write off a lot of things that you do, of course, for work and also other personal things like hanging out with friends or driving to meetups or food for friends, all the good stuff. So this is how it's going to work. He's going to do a little of a talk, and then you guys are able to ask questions. So I'm going to be helping him facilitate the questions because we're going to have to switch to another screen as well. So if you have questions at any time, please do drop it into the group chat. And if it's appropriate, then I'm going to bring it up at the appropriate times if it's at that specific topic that we're talking about. And if it's not, I'll hold it toward the end, and then I'll bring the questions up to Tony. So if you guys have like quick questions or anything that you want to jump on, you can also raise your hand, and then that way I can call on you, and then we can unmute. So without a further ado, I'm gonna turn this over to Tony, and don't worry if you guys can't like stay for the whole thing or anything. I will be recording it and sending this out. All right, Tony, take it over.
Okay, cool. Appreciate it. Oh, you don't want to talk about your event, dude?
Oh, what events are coming?
This week?
Oh,
Next
that's
week? Come
right.
on, man, dude.
Oh my God. So, couple big things. My brain is fried, and I've been agreeing to things I normally don't agree to. One of which, so next week we're gonna have the anti-conference in Las Vegas. So Anita is hosting this amazing event. It's gonna be held at the Caesars Forum. We have a lot of amazing speakers, and then on impulse, because one of my good friends who runs a 1031 company somehow he loves me so much that he is sponsoring my hotel suite. So we're gonna be hosting an after party at the Resort World. And it's gonna be sponsored. My room is sponsored by our friend Wei Ming Peng at the 1031 Exchange. And then food and drinks will be sponsored by Big Daddy Kainuan of Absolute Mortgage. So it will be held in our hotel rooms. Come and hang out after the event. Lots of business, lots of chats, lots of talking about how to save on taxes. And then the other impulse thing I did, and which I'm really, really proud of, is we are signing up for CircCon 2026. I signed the contract, I paid the deposit. We're doing this again. But before I announce it to everyone, is one thing is bring your Crocs. I'm just telling you. Crocs this year. If you went to LobbyCon, you'll know what I mean, but we're going to 10x what we just did in LobbyCon with the Crocs. And there will be a lot of prizes and cash prizes for those who do wear it. There will be a lot of games. So please, please, please do come. It'll be a very, very special one. All right. So I'm done with announcements. Turning this over to my bestie, Tony Hoon.
All right, cool, perfect. All right, nice. Now that you got that out of the way, now we can go to the show. So, the more important stuff. So cool. Appreciate everyone joining here tonight. Definitely recognize some familiar names here. So appreciate the time joining. And then, yeah, if you guys want to chat, so tonight we're going to be talking about small business and tax hacks, tax loopholes with it. If you guys just want to drop in the chat, if you have a side hustle, what it is, and we can also use those as use cases. If not, I can just go more general and I'll just draw on the iPad to go over on that portion. So, oh, nice. Solid business. Yeah. OF. Yeah. That's fun fact. What they were a client, no longer anymore. I think their spree ran out, but it was a dude, they did seven figures on OnlyFans. So I was like, Jesus. But yeah, cool. So we got off-road influencer. I like that. Day trader and realtor, online fitness coach. Yeah, there we go. Yeah, hit Mike up. He's got the coach going. CPA firm. This guy's got jokes. Davis has an attorney firm, law firm on that side, and house flipping. What's up, Brian? Nice. STR coasting business. Okay, so we got a lot of good ones in here. So yeah, I'll try to actually use all the examples that are relevant to what everyone said here. Yeah, so cool. And then, yeah, so I'll fire up the iPad and then, yeah, just kind of quick background on myself is, and I found this out through social media, which is kind of weird. Apparently, people think I'm just like a dude that talks about taxes, like a tax influencer, but I'm like, no, I'm actually like a real CPA and do taxes and run a firm. So that was shocking to know. So yeah, if you guys didn't know, like, yeah, name's Tony Hong. I'm the CPA dude with the CPA license that runs a tax firm that actually serves clients. So we're a team of 31 now. And yeah, heavy real estate focus, heavy business focus, and high W-2. Those are like our three areas. And the big thing is always tax planning. So, anyone from the call here is like, have some tax plan is better than no plan. I think the Ben Franklin quote always goes with, if you fail to plan, you plan to fail. Yeah, I think that's what his quote is. So it's always like, you don't build a house without a blueprint. You don't go work out without a workout plan. Same thing goes for your taxes, is you don't file your taxes without, some type of tax plan. It can be really basic too. It doesn't have to be super complicated. It can literally just be 7,000 bucks into traditional IRA. Hey, get the employer match from the 401k. Like it can be as easy as that. It doesn't have to be anything crazy. So we'll put more of this in here. So, all right, cool. And then, all right, cool. So I will fire this up in here. And yeah, let's get the show started here. And then just drop your questions in the chat. Feel free to raise your hand if you want to, be brave and hop on the, which one, call on that side. And yeah, we can bring you up to screen here. So share screen, start broadcast, 3, 2, 1. Okay, cool. Okay, cool. So kind of like tonight that I really want everyone to like realize is like you should have some business
Tony, can
rig.
you move the little tiny screen off of the
Oh,
white?
you don't want to see
All
yourself?
right.
Yeah.
No,
Okay,
it's too awkward. There we go.
okay, cool. Yeah, nice. Perfect. Yeah, so regardless, like you don't need a full-blown business that has to be like your 9 to 5 business. You can still work your, 9 to 5 and still have like some small business. So the tax code, obviously, everyone in here knows that the tax code is written really well for real estate investors, people in real estate, but the tax code is also written really well for small business owners. So that's why I'm saying have some side hustle is better than no hustle at all. So the big part is, deductions that I want to go over. So deductions, there's just the two prongs to this. The first prong is just going to be, is it ordinary? And then the second prong, is it necessary? So very similar to your rentals is as long as you can meet these two items, if it's ordinary and necessary, it's going to be a write-off and it's per your business though. So what it makes sense, for, me to have, I don't know, like if what's something that's not ordinary, I would say is, I don't know, me buying 50 big screen TVs, not very ordinary for me. Is a TV necessary though? Yes, it is. So I got one back here. I'll write that one off because I'm like, all right, I can flash some stuff on it. So deductions is like anything that's ordinary and necessary. And the beauty of it though, and why I would say everyone should get some type of side hustle or a business and, quit your 9 to 5 and, hop into it, is that everything that is a deduction is pretty much a discount. And what I mean by that is the government's funding your discount. And let's just pretend that you're in the, 25% bracket between federal and state. That means everything you buy is 25% off. So with the new iPhone coming out this month, say that thing is, I don't know, 2,000 bucks because you upgraded for like the 1 terabyte of storage. That's only really $1,500 out of pocket that you have to spend for it. So having any type of business vehicle, a mechanism to write off expenses is amazing. So that's like the big general parts. Like these deductions are great as long as it's ordinary and necessary. So what you want to do is one, keep your receipts for it, and then two, just account for it in your bookkeeping. So just having your documentation in line is always the most important. People hate it. I'm always like, yo, dude, just take the picture of the receipt right when you're done, store it in, and then just put it into a drive folder. So deductions is the good part from a small business side. So that's the basic part, but a lot of people miss out on that. Like I had one photographer client, I just combed through all her expenses and she like missed like 27 grand. And I was like, dude, like, taking the same principle of 25% on 27 grand, that's well, like just crap load that you're losing out on that side right there. Was that 7 grand roughly? Yeah, almost on that side. So 7K that she lost out on that she was able to recoup. So knowing what your deductions are super important. So that's kind of like the big part from a business side. So that's kind of like the foundation. And now let's just actually take like practical examples that you can use for your businesses here. So, if I'm like, let's say, hey, I'm A&E selling Nelson's Feet picks here, is that we can actually use, the home office deduction. So that's like your tax strategy number one is your home office deduction. On this one here is the beauty of it is that part of your home office or your home can be deducted. So if you're using your internet, to post those photos on that side, you have all your utilities that you have. So your water, your gas, your electricity, and then so let's just pretend either you rent or you own and you can use part of your home for depreciation now. So that way you can get part of that, your insurance on this side. And then say if you have any other like, say you have a cleaner that comes through. So you can get, anywhere, I'd say nowhere more than 20% pro rata of all these expenses up here. So usually you kind of get blown up on an audit though if your home office is more than 20%. So just keep that in mind if you are taking the home office deduction. So that's going to be the first part. The second part too is like, hey, going back to deductions is what's a great deduction? Number two, don't got any myself, but anyone that does have them, kids. So making your kids part of your business, you always hear about that. So this year, the standard deduction is 15.75K. So, oops, can't draw or write. So 15.75K. Now, that's all tax free that you can pay them. But that's the pretty side that everyone talks about. Some people don't talk about the ugly side. So in the tax world, there's nothing that's too good. Like if it's too good to be true, it seriously is. So like, what's the catch on paying your kids? The catch here is documentation. So no one likes to do documentation, but you need to. So that's one. You want to make sure you document. Two is it's a fair market value. So yes, no, maybe so. Good. Okay, cool. All right, sounds good. Yeah, the screen said muted, but all right, cool. So the other part of paying your kids, it's fair market value. So when I say fair market value, is like if you were to pay someone else the same exact job to do, would you pay that same rate? So would you pay someone $400 or $4,000, say, to clean up your yard for the day? Like realistically, you're not going to pay someone else to like clean up your yard 4,000, right? You're not going to do that. What's something more realistic? It's $400, right? So as long as you document that and have real rates for it, you can pay your kids and they'll get all that money tax free. So if you got two kids, pay them 30 grand, your tax rate's 25%, you're going to save 7.5 grand that way right here alone. So your kids can be like an excellent write-off. The other general premise here in the tax strategy that I call is just income shifting. So this not only can be your kids, but there's, good old Asian families here. You got to support mom and dad. So, if you support your mom and dad, right? Just make them work for you. Like do a little bit, and then you can pay mom and dad. That way, if you got siblings too, you can pay siblings. So the general thing from an income shifting strategy is that you want to go from your 37% bracket down to some other bracket that's lower, right? Whether that's 10, 12, 22, 24%. You just want to keep on finding other brackets to put that money into, or if not zero, right? That's where the kids come into play. And then you're just kind of like just arbitraging the difference on that side. So the income shifting is like a really strong strategy, and this can add up. Like I literally just before this call came from a guy, he's a doctor, he's got three kids. Like we're just gonna ring up 45 grand for him right away. And he's at the 50% bracket. So that's gonna save him 22.5K. So, income shifting can be really good. And then his kids can use that money for his sports and everything. So income shifting is a great strategy. And then, yeah, just going through here for the folks that dropped it in here. Let's see here. So we got next example. So off-road influencer. Yeah, for Michelle. So off-road influencer, going back to deductions again, that's why I wanted to start with deductions up top, is, hey, so I want to call this more of in the hobby, but business. Like I think the keyword is actually not to use a hobby. It's your passionate business that generates income. So what I mean by this is that you have interesting. You got an echo? Okay, I think we're good again. Okay. So maybe it's my computer. But anyways, It's your passionate business, or the other thing here is your W-2 converted to a business. And when I talk to clients, a lot of people hate their W-2 and they just don't like the shackles. And I'm like, well, you can just turn your job into a business, right? So it's your passionate business or your W-2 into a business. So we want to convert anything you like to do or anything that you hate to do, but want to make it better into a business of some sort. So what I mean by this is just to say, hey, we're an off-road influencer. And on this off-road influencing, what are ways that you can use the tax code to your advantage? So one is, let's just say that, the parts for the vehicle that you are influencing on, those can become a write-off because there's other ways to generate income. Say you're going to grab a brand deal. Two, you can have races from the side. Three, you can have like sponsorships. So, however creative you can do, this is where the business acumen actually comes into play, though. So it's like, cool. Like, how can we write those things off? So, other parts that you can have is besides that is all the electronics. So the electronics that we have is like the iPad I'm drawing on right now. If you have cameras to do your influencing on to convert, it also if you have storage space. So if you have like Google Drive, like G Drive, or your Apple iCloud, you can write all those items off. So it's kind of like the world's endless. I could probably go all night about what deductions, but going back to what's a deduction, it's what's ordinary and necessary for your business. So there's many ways to do that. Now, going from a larger zooming out, the W-2 to business, there was actually a good handful of people I worked with that were in the, I think it died out though with the return to office. So for a while, I was picking up clients in this whole like overemployed crowd for a bit. And this was really interesting. So they had the W-2, which was like the 9 to 5. Then they added in like a 1099 job and then another 1099 job on top. Like, so they would have 2 to 3 1099s. And then these dudes were making like triple. So like say if this is normal like 200K, this job was like 200. This job was 200. So they were like using the same 9 to 5 schedule though to make 600 grand though. So it was like nifty. I was like, damn, you're clever as hell, bro. So I'm not sure if it's like, yeah, it was pretty controversial for a bit because they're like, well, you're kind of stealing company time. And I was like, I'm just here for the taxes, dude. I'm like, you can consult your, own folks for whether or not you should do this. But, even if you don't have to pick up a second job, can you take your existing W-2 skill set and push it into, a job? So let's just pretend you're a data analyst, right? Today as a W-2, could you go find a gig that was just 1099 data analyst, right? So any job that you can do as 1099, if you know how to use the tax code, is actually way more beneficial for you. So let me just like run you through an example of like, and then sometimes I tell folks, I'm like, especially the people that do sales that are on W-2, you should definitely go ask to be 1099. But let's just use a 100 grand example here. W-2 versus 1099. And what's the differences here? So on this part here, you have self-employment taxes of 7.65K that you pay. And then Social Security, Medicare, that's, pretty much it. So you're going to net back, post-tax, roughly about 93.35K here. That's your net take home after taxes, right? And then that's self-employment taxes. But then let's just use the easy example here. I'm going to move the tax rate down to 20% because I don't want to do the math. So this is your payroll taxes on, and then I'm going to just use 20% as this one just for easy sake. So I'm going to say like 18 grand. So I'm roughly down to 75K here. That's my net take home after all taxes. Now, let's just hop into the 1099 world. Payroll taxes, you're going to get played on. You have more because you're employee and employer now. So that's going to kill you for 15.3K. But now let's go through all the cool deductions you can get to see what's left on the 20%. So first, you're going to do, yourself an S corp, right? So then your wages, maybe pay yourself, 40 grand of this here. So then only this portion is subject to 15.3%. So now if I just take this, that's roughly around 6K. I'm just doing quick mental math here. It's not perfect, but that's 6K of taxes. So now we are actually paying less in payroll taxes, right? In the W-2 example, it's $100,000 times 7.65. And the 1099 paired with an S corporation, you only pay self-employment taxes on what you pay yourself. So here we're down 6K, so I've saved you 1.65 grand here. So that means we have 60 grand left to play with. Now we're just going to run, the great examples that we're going to do. So income shifting, we talked about, say you're going to do 15K here, home office, or we'll talk about this later, the Augusta rule. Say you juice that up for another, conservative 7 grand. And then say you just have your normal, like living, not living, but like your normal day-to-day expenses. So some car mileage, some cell phones, some electronics, toss in a meal here or there, toss in a quote unquote vacation. I'll write that down to come back to later. And then also some continuing education. That'll just, let's call that $1,000 a month. So then that's 12. So now we're 27 plus, so 27 plus 7, that's 34. Should probably script these examples in the future, but it's all good. I'll just do mental math as we go here. So that means that we have 26K of income left. And then say we're paying 20% on here, that's 5.2K. And then we pay 20% on the 40K up here. So that's a total of 8K. So you're paying a total here of 13.2 plus you have let's see, 6K up there. So you're at 19.2. So your net take home now is going to be 80 grand versus 75 grand. So literally same exact job, you could have an extra $5,000 in your pocket just by structuring and using the tax code the same way. So this is just like a really high level example. There's way more you can do. Let's just pretend that I wanted to layer in a solo 401k and I stash away 23. I pay myself 40 so I can stash away 33 grand on here. Well, I guess if I stash away 33 grand, I don't even have taxable income here anymore. So I guess technically I just wipe away this whole entire part. So I only pay 6K in taxes. So now you're looking at a take home of 94, right? Post versus 75. So once again, like how extreme you push it is really up to you. And I always tell folks, like when we go through tax planning, I'm like, dude, are you like a church going, like good person here, which is great, don't get me wrong. Or are you on the spectrum of like Vegas and you love drinks and like to party, with people? And the same goes with your taxes. It's like you can take super conservative positions here. There's nothing wrong with it. You're just going to pay more in taxes. And you can also go Vegas and you can pay way less in taxes over here, but they're still legal, but you may have some arguments to be made from how aggressive you want to be. So what spectrum are you on? I would say church or Vegas. Where do you sit on this side? So that's like kind of the strategy here of like income shifting to now I'm saying, hey, you should turn your passionate business or W-2 into your business because there's so much more tax benefit towards that side. So, a couple of things that I alluded to up here that could work. I mentioned the Augusta and vacations. So let's talk about the fun stuff here for a bit. So we're going to talk about vacations. We'll call these the fun ones. You got number one, vacations. Number two, you got meals. Number three, you got travel. So, and then four, let's just go for fun, the G-Wagon on this side. So these are all the fun ones on this side. But before that is you don't want to spend money to get a tax deduction if you actually don't need it. So like don't just like recklessly spend your money just because you don't want to pay taxes. So like the classic example is like, bro, you probably actually don't need a G-Wagon. Like you probably want to buy something a little bit more economical, like maybe a Sequoia instead, right? Maybe what else is like heavy and functional on the side. So I would just use Sequoia or a Sienna. I wonder if Siennas are over greater than 6,000 pounds. But use something that's practical. If you want the flash and whatever your industry you're in, sure. If you're a realtor and you want to show up styling, G-Wagon's fun. But I always just say, don't let the tax tail wag the dog, right? So taxes is just a cherry on top. Just be smart with your money overall. So diving into it now is just like make all of these income producing for you. So like from a general perspective, and this is more or less on the tax, but more so from like a straight business part, is whatever you do, you always have an opportunity cost. That opportunity cost, you need to account for it, and you should always be mindful, is this going to produce me income? So like, if I'm an attorney, I'm billing every single minute of my life, me going to the gym is probably going to cost me $1,000 an hour, right? Versus, oh, I could have just sat behind my desk and billed $1,000 an hour. So that may or may not be applicable to you, but be aware. So what I mean by this is if you take a vacation, this vacation better be to network. And what do you always say? Your net worth is equal to your network, right? So this is you better go meet some people and you better go learn some skills. Like this one, if you're legit just gonna be going here, just go chill on the beach and do nothing, like don't even like just don't even go on the vacation. Like you do need some agenda no matter what if you go on vacation. The IRS will blow you up. Like we have an IRS tax auditor on our team, and the easy things that he blows people up on vacations and travel is that they don't have an agenda. So if you don't have an agenda of like the who, what, when, where, why, you're gonna lose those deductions automatically. So vacations make it income producing. Number two is meals, right? Meals, these also better become income producing for you also, right? So at least the beautiful thing is you have to eat, but sadly it's only 50%. So if you take the whole fam out and it's a 1K tax or 1K bill, you only get $500 as a write-off. But once again, it's income producing. Like, who are you eating with? Why are you eating with them? Document these two things on receipt because, like, the rest is there the where, why. Who, what, when, where, why is always what I say. So, who are you eating with? Why were you eating with them? So you want to make that also income producing on that side. Vacation travels, I guess I kind of double dipped. And then lastly, like the fun part, like the G-Wagon is, even, do you need the car? I always tell folks that. Do you first need the car? Yes, no. If it's a maybe, okay. And then also like think about the long-term cost of it too. So cars, that's like a whole nother series you can probably dive into. But this is a ton of like, you can literally just wipe out your income a chunk this way. And also speaking of this, I think I've been shouting it for a long time, but just for everyone that hasn't heard, is right now by the end of this month, so end of month, is the EV tax credit is gone. So if you ever wanted to buy an EV vehicle, you have to like order it by this month. So if you want those cyber trucks, you want the whatever Model 3, whatever you want to buy, do it by the end of this month. Otherwise, that 7.5K tax credit is gone. Do be aware though, there are MSRP restrictions on the vehicle and there's income restrictions. So do consult your tax person before you do it. Also, ChatGPT is not the best source. There was actually a pretty funny thing yesterday I saw was like, it asked something about rep status and like ChatGPT got it completely wrong. So like don't trust ChatGPT yet. Maybe 18 months, maybe. Right now it's not there. It hallucinates. One time I was just playing around with it and I got tenants in common and joint ownership wrong even. So it's don't trust it completely. Validate it. So that's the vehicle portion on this side that you could do. And then I'm going to keep on just rolling down on some examples on this side. So day trading, realtor, online fitness coach, house flipping. Okay. So realtor. Okay, cool, cool. All right, so we got through, let's just go through. Okay, cool. That makes sense. So realtor, and actually this is probably everyone's favorite, and they love structuring. And I'm always like less is more type of dude. Like I'm really basic. Like the KISS method is always my style. The keep it simple, stupid method is always my style. But people love talking about structuring. So from a business perspective, this could be good. So I'm going to tie in first the example as a realtor, and then two as a rental PM. here, just so this can double dip. So structuring, right? And the million-dollar question is always like, do I need an LLC? Do I need an S corp? Do I need a sole proprietor? Do I need a C corp? And, the good old answer is it depends. And it really depends on your situation. So, realtors and like even like rental PMs, generally speaking, on these here, we have most of our clients start off as an LLC. And then once they make, greater than 50 grand of net income, so this is after all your expenses, then you're gonna like evolve from like a Pikachu to a Raichu, and you're gonna become an S corporation. And the reason why is because you're gonna save on self-employment taxes. So that's gonna be like one of our bread like go-tos. If you have any type of active income and you are more than 50 grand of net income, you really want to like probably be an S corp on the side. Now, the bad side of it, and always what I see is no one ever has bookkeeping. So if you have an S corp, like go budget yourself 6 grand a year to get some like for just the maintenance of this thing. So this is going to be from your filings to your payroll provider to your bookkeeping. Like these things are kind of like what I call it. It's like a Mercedes Benz. Like it's expensive to drive, right? It's going to cost you a lot to maintain, but it can save you a ton of money. So S corps are great on that side. Just know the maintenance cost of these is probably, I would budget around 6 grand to do it right. Now, LLCs, you can always start off as an LLC on the side. And, as our fellow attorney would always say, like, having a business without an LLC is like driving without insurance. So you may want an LLC. So it doesn't change anything from a tax perspective, but it does protect you. And also you can backdate an S corp election. So LLCs are great. It's a good way to start. California, you just have that lovely $800 fee, which sucks, but it's just kind of like the cost of doing business in the state. So starting off as an LLC could be beneficial for you there. Just always consult your professionals. And then one thing that I think one time there was like this, I won't say viral post and share, but it was the very like interesting one. And it was the this dude, I'm not sure you remember Andy, the dude had like 90 units or something like that. And then he talked about having a PM company where he runs everything through. And essentially, this is the C corp play here. So this is when you have like a shitload of units, like where you have too much money, my friend, at this point, which is fine. It's cool. Like we should be friends. But this is where the C corp becomes the PM company for your own rentals. So let me just show you this here. So I got LLC, I got C corp here. And the reason why you use a C corp is it's considered a blocker entity. A blocker entity simply means that none of the revenue, so let's just say it's like, hey, I'm Annie, I'm down here on this side. Excuse my stick drawing, it's not that good. But um, LLCs and S corps right here, the income passes to you because it's a pass-through entity. C corps, though, that does not exist. C corps are legit standalone entities and tax themselves. So this is where it blocks all the income. So let's just say that you have 90 units and it's generating, $1,000 per month. Or let's just say, yeah, $1,000 just for easy sakes. I'm gonna say 100 units. I don't really want to think tonight. So it's 100 units, and you charge your 10% normal PM fee, right? 10%. So you have 10K that you're going to send to your C Corp each month on this side. And that way, the C Corp is used as a blocker because it's only 21% rate. But if you got this many units, my friend, you're probably easily at the 37% tax bracket. So now you can see there's the arbitrage of the 16%. So this is kind of like when you want to get more sophisticated. I have seen this set up on a smaller scale, and I was like, I didn't quite agree with it because I thought it was overkill. And I think that prior CPA just wanted to create more work to grab more fees. But that's my personal opinion. Don't know that person. But I was like, bro, why do you need all this shit? Like, you don't need it. You're not there yet. So we closed it down just to make it easier for them. But, something you want to consider. So on this side, blocker entities are great if you make big money like that. And then also, say if your S Corp blows up. So let's just say on this side, your S corp is going to generate, Danny's going to blow up the STR co-hosting business that he has, and it's going to make more than 750K of net income. At this point, from the math that I've tentatively ran, after all the deductions, so the QBI, the PTET, everything that I talked about there earlier, it's actually time to like, oh, I should use a better example. Because there's nothing that evolves after Raichu, right? Okay, so going back to like Pokemon examples here, is that what did I use? It was like the peak. Oh, right here. Let's just use this is the Charmander that evolved into the Charmeleon. And then this S Corp, you may actually want to revoke your S Corp election and like evolve into a Charizard and become a C Corp. The reason why you become a C Corp is around the 750K mark. You start to save that delta of that 16% between 37% pass through to yourself versus 21% as a C Corp. So that's why all big corporations, especially when Trump came in, he knocked down the C Corp rate from 35 to 21%, is because it's to give them a break on that side. So, if you're blowing up big on that side, that would be huge for you in terms of like restructuring your side. So that's kind of using one example there.
And then
And then,
going back to arbitraging the difference, so if they're doing the 21, do they also not have to pay like the self-employment taxes or anything? Like from that property management going through in there?
oh yeah, so looks like my iPad said it's night motion. Yeah, geez.
Oh,
Okay.
it looks good. Still looks
Okay, I
good.
was gonna say, should I try to turn it back? Yeah, so you still have to pay, you don't have to pay as much self-employment tax. Self-employment taxes, whether you are C or S, is only on the salary that you pay yourself.
Mm.
So you can always control it that way. And then so that 15.3% is only on what you pay yourself here.
And can I pay myself less, but then do like some kind of owner distribution?
So C Corps, you
Like I
can
say,
take
because
it out
once I
as,
like if I'm a stock owner or whatever, if it's like a C corp, then I have like yeah, like dividends of some sort or some kind of
yeah,
distribution.
so yeah, you can take it out as dividends and then you won't be taxed on self-employment taxes. You only pay ordinary income tax. Distributions, same thing again. So dividends and distributions are very similar in terms of how they work. But if you get into the dark side of C Corp planning world, and this is where you kind of get into the hot water, is C Corps. You will hear a lot of like executives abuse this
Um,
here. So it's always the executives, right? Is that they will just take a loan against the company, and that loan just sits on the balance sheet forever, and they will slowly pay it back, but they don't pay any taxes on this side. So once again, that's where I say, hey, are we going to church? Or are we going to Vegas? Like, pick your poison. What tax position do you want to try to defend in the future? That's going to be how that works. So that's where C Corps can really make a difference once you get into these higher levels of net profit.
right, because I'm also thinking like even if they don't like if they, you said you mentioned the loan, even if I don't get a loan from my own company, if I arbitrage it elsewhere and then get a loan from elsewhere, it's still cheaper than me paying taxes.
Oh yeah, yeah. That's just where you can like let's just pretend that you took a loan out. No, you still pay like, fair interest of 8%. And then you loan that money back out at 10%. You can pay it back and make a 2% interest income. So other ways to think about C Corps. And yeah, that's just like the fun part about what I enjoy about tax planning is like it's actually kind of endless in terms of the permutations that you can think of. It's just really how aggressive and what's your end goal that you're trying to achieve. So C Corps is like another cool area to play around with. And then this is like high compliance though. Like to do it right is a lot of books, good payroll, like filing the returns. But it's kind of like an area. Most people kind of like shit on C Corps though, because they're always like, oh, C Corps, it's double taxation, and I get it. Don't get me wrong. It is one, the court pays taxes. Two, the individual pays taxes. So you do get taxed on it, double the tax. But that's only if you don't pay yourself out anything. So you pay yourself less here, you get taxed less. Keep more here, play around with a loan possibly. But it all depends on like how aggressive you want to be with it.
And speaking of the corpse, didn't I remember last week you said that about the new bill coming out that about selling your business and then something about like you don't have to pay taxes or something, but it has to be in either a C corp or an S corp. Those are the.
Oh, yeah, yeah. Nice. Oh, you're already listing this
I
stuff. Yeah,
was
so
paying attention, totally.
yeah, so in the new tax law that came out, there was the QSBS. So this stands for the qualified, oh boy, do I want to write it all? Sure. Qualified small business stock. And this is if you ever wanted to, so this is only for C Corps. And what this will allow you to do is that you will sell your company one day, sell your company. So you know you're going to exit. You're going to sell your company and you can get, up to $15 million tax free. So that's kind of like everyone's dream on that side, right? Like stand up a company, have a startup, blow it up, sell it off, and you get $15 million tax free. This went up from, it used to be $10 million before the new tax bill passed. So it went up 5 million bucks, which is huge. So just other ways of how you can actually start structuring your startup. So it does take, this does take 5 years to start the clock on. So actually, like one other Sarah member and I, we actually as formed up one and then just made we just wanted the clock to start ticking in terms of just having a C corp. We'll probably never do anything with it, but maybe we will. So it's just better to have than not, just in case you sell your company one day, you can wipe away the capital gains on that side. Good question though. So those are some strategies that we're going through on this side here. And then in terms of going through there, let's see, so those are a good chunk of items. Did I talk about the Augusta? No, I did not. So this is probably a fun one for folks, related to the real estate side, is you can use the Augusta rule. And essentially this is where, came out of the golf tournament where you can rent your home um, to your business 14 days per year tax free. So once again, just like when I was talking about paying your kids, it has to be like a reasonable rate. So what I would go do is go on Peerspace for your area and then see what the corporate rental rate would be, and then just use that and use three examples, average the three of those. And then you can, anything in the Bay, I mean, you can probably easily get 1K per day on that side. So if you do that 14 times a year, that's 14K that you're just shifting around. So you just literally move that from your business account. You're going to invoice it to the business, then you're just going to pay the personal account, and you pick up this 14K tax free on the personal side, but your business gets the deduction now for this 14 grand. So once again, if you're paying, say you're in the 20% tax bracket, that's, 2.8K right here. Oops, 20, 3K that you're almost putting back in your pocket right away. So the Augusta rule is really strong for you there. And it's a great way to just, you always want to use money you don't actually have to spend. So like what I mean by this is like, pay your kids. It's the same house, same team. Pay your home, your house from your business to personal, same team. Pay your parents, same team, right? They can gift it back to you for God's sakes too, right? So those are ways that you can keep more of the money. And then the other big thing of like keeping more money is deferral strategies. Um, and this is still keeping the same money without having to spend it. So deferral strategies, the one that we are always used to is the 1031 exchange in real estate. But from a business side, the solo 401k, this is a big area where you can stash up to $70,000 per year. You have SEP IRAs that you can do this with also. Once again, that's 70 grand here. It's either one or the other, though. You can't have more than 70K. So those are two areas where you can stash a crap load of money. Once again, all of this is just it goes from like one cookie jar to the other, and it's still both your cookie jars, right? These are like, say it's just the Tony jars here. No matter what, you get to keep those. So, and then you can save for retirement. So if you stash, actually a fun fact for everyone is that, literally everyone on this call is a millionaire. It's just a matter of when. So if you save 10K per year in taxes, or, you just can save this compounded over 30 years at 8%, you're going to have 1.3 million. saved up. 300K being tax savings is what I tell our clients. And then $1 million of growth from compound interest, which is, I think people joke and say it's like the eighth world wonder. I like to call bonus depreciation the ninth world wonder. So that's also the big thing of like why does all this matter is because literally every single day you have to pay taxes. Like you wake up, you work, you're gonna have to pay some towards taxes. So it's in your best interest to, as much as you can, anything you spend money on, can you make it a business deduction? That's why the whole call started off with that deduction on that side. So those were some big things here. And then, Jesus, I've been yapping forever. So we got 5 minutes apparently. Okay. So I could probably keep on going on and on, but if there's any questions that anyone wants to drop here that we can answer for folks, and then I can stop yapping at the same time too. So yeah, if anyone wants any questions answered, feel free to drop them in the chat and we can answer those also. I know I was talking a lot here. Cool. Let me just stop this and hop into chat. All right, cool. So Brian, for the Gus role, each month's meeting, we need to have a written board of director minutes, correct? Yeah, so it can be board of director meetings, as long as it's some business purpose. So you can do what I would do would be 4 quarterly like goal meetings, one annual planning session. So you got five right there. And then if you have some team events that loop in with like holidays, so if you're gonna have a Christmas party, Thanksgiving party, add in a couple more there, so you're up to eight. And then seeing whether six more you can squeeze. I got one I got looped into. He was a solo S corp guy, and then he's like, dude, what can I do? And I gave him some ideas, and I was like, oh man, fuck it, I'll just come to your house. We can have a tax planning session. So I'm gonna go down to Newark and sometime in Q4 and chop it up with a guy about taxes, which is fine. He's hilarious actually. He started a Pokemon business actually. So he's really into Pokemon cards, and him and I geeked over that. And yeah, so I was like, he's going to some like local card shows now, and he's selling the cards and got them on whatnot to sell. So yeah, it's like anything you can turn into a business, they're like legit write-offs. So yeah, Danny, no monthly meetings. Yeah, you can have monthly meetings. You just have monthly team meetings. So like if you want to just have your contractor come over and be like, yo, dude, what's the plan on how we're gonna get this house done? Let's smash it out, and then you can invoice the company, and then the company can get a write-off on that side. So whatever the agenda is, like what was the real business purpose of it on that side? Like for one example, I had my team over for 10 days. Yeah, I had my team over for 10 days. I'm using all 10 days of that because I housed them, I fed them, we did training at my house. So I'm going to use that as an example that you can use. So anything from a team side, it's easy to do. Um, and then Mike's got two small businesses, rent, home kind of expense, say my T-Mobile bill or utilities on both businesses. As long as it's just counted in totality, the net total amount. So let's just pretend like your T-Mobile bill is $100. Like you can't write off more than $100 though. So like each business couldn't take 100 each. It would have to be for the total amount that you're actually spending that ties out to like the bank statement or the receipt on that side. And then cool, nice. Yeah, get some ideas. Yeah. Have Danny over, man. Just you guys can chop up real estate, have a little like conference idea mastermind session. So the world's kind of endless as long as you have a good purpose for it. But even if you're going to talk about flips, so like, hey, who's good contractor, who's bad contractor, don't use this guy, how's the state of the market look? Those are items for you to think about too.
I have a couple more questions in here.
Oh,
Um,
okay.
back into your meals, you said that meals and entertainment is not at 50%. So say if I was hosting an event, but I'm bringing catering in, can I write, is that still part of the 50% or can I call it like an event expense?
Catering. Oh, catering, I think is 100% actually. It's the meals out at restaurants. Because generally it should follow like the one I know off the top of my head, like for definitive is like it, it was back when I worked at public accounting, or like, you know what, like why companies have food at like 6 or 7 p.m. is because it's for the benefit of the employer. So that's 100% write off. So you actually work that late in order to get the food. So like they're catering in. So that's 100% write off for them for sure. So, but events like Sarah, that one should just be 100%, I believe too. Like because you're catering, oh Jesus, you're catering in to keep people at that location.
Yep. Cool.
Yeah. Hmm.
I was thinking, so because I see someone, Brian in here, he's in house flipping. So if say he does flipping and he has everything like a single member LLC and he's racking up a lot of like six figures in earnings, how would you be able to write down like the deductions on that? Because after paying off the contract and everything, you still have like a giant chunk on there.
Oh, giant chunk. Yeah. So generally speaking, in the nature of the business, and then Brian's, I know specifically is, S corps are always a great way to shield income. So then you can just start running these as through an S corp, pay yourself a salary, start doing some like income shielding from solo 401ks. You can start juicing those out, start deferring things, start running as a business. Other items that you could do if you're, starting to get heavy into the flipping part is if you just want to create all your own staging. Like, so if you want to buy all the furniture and the storage for that, because you need to stage each house each time, you might as well do the vertical integration. So it's like, what things can you vertically integrate within your business to reduce the income, and then start doing those income shifting ideas. Who else can you pay on that side? And then even if your mom and dad are in like the 10, 12%, but that year, say you're in the 37%, you might as well push them up to the 22% and shift a crap load of income that way also. So moving income around is always great. And then what if it gets like super crazy, then you start doing a little bit more, like you start pairing in other strategies on top of it. So like tax planning in general, there's never a one like big splash. Maybe an STR loophole or reps, that those are big splashes, but you start incorporating other strategies on top of it. So also, if you have a great big huge income year, consider doing STR loophole. Or two, if you're in that state business already, maybe you start doing reps. So then you can buy a property to depreciate to reduce those gains. There's other advanced strategies. There's one that we recently just started using this here, and this was more in the creating capital losses to reduce capital gains. So if this is just like a one flip and it's not ordinary, that's another way to reduce it. And then there's all the leveraged charitable donation type of ideas that you can do, foundation type of ideas that you can do. So there's a recent guy I just kind of started up a kind of like I'm gonna say a partnership with, but like a referral connection. But he's specifically in the nonprofit space to help set up foundations. So you can shield and you put 30%. So let's just pretend I made $100,000 this year. And I'm like, I don't want to pay taxes, dude. What can I do? And then I could put 30% of my adjusted gross income into that foundation. So just like the Bill and Melinda Gates Foundation, you can have the Sarah Foundation, the Annie Foundation, the Tax Literacy Foundation. I'm gonna go put 30 grand into that. So now my taxable income is only 70,000 bucks, and I only get taxed on that. So I just saved $30,000 off of adjusted gross income. And then I only have to donate 5% of the asset value out. So on that side, then I only have to, push out what, 1,500 bucks as a scholarship towards whatever cause or whatever I want to give away. But then this is where the rich get richer and why athletes have foundations. You hire all the homies, and then you wipe away that you pay out that $30,000, so you have nothing to donate and give away anyways. So there's like levels and tiers to this stuff that you can get pretty deep and advanced into. But yeah, just spitballing a whole bunch of ideas out there. The whole thing for like taxes and like what I want everyone to take away from this call. If you remember nothing I said tonight, literally just some tax plan is better than no tax plan. So do something, my friends. Just don't give it to the government unless you love paying taxes. Be my guest. But that's not what I stand for.
Oh man, that's a lot of fun things.
Yeah.
Well, say from if he was starting with an LLC with a flip, is it also the same like 100,000? That's the mark that he should switch to S corp and start writing all of that. Like is that your magical number-ish?
I go usually 50 to 70K, but flips is quite sensitive. So flips is like it's always an it depends, because flips you could roll into an S corp if you're doing them continually. So say you're doing like 2 to 3 a year consistently, but if you're just like feet wet and just doing it once, probably just get the LLC just to protect yourself at least. You may not need to upgrade into the S corp yet, because S corp's for ordinary income. Is it ordinary that you're flipping all the time? Maybe, maybe not. So it really depends on who that is.
Mm.
Yeah.
Good ones. All right. Next question is from Mike. So, if he has two small businesses that he runs at home, can he expense his T-Mobile bill or other utilities on both businesses?
Oh yeah. Oh, we went over this one. Yeah, it was as long as it equals the total amount. So like if the bill's $100,
Hmm.
then you can't write off more than $100.
Okay, so and then
Yeah.
unless like on each side, like you mean like 50-50 or like just whatever the bill is. They
Yeah. Well, whatever the business
a
use
big
would be
bill.
allocated. Yeah.
Good.
Yeah. Oh, Jenny's got the discount, yo. Yeah, like
Eee,
20%
20%
off. Yeah,
off.
AT&T, Verizon, and T-Mobile, 20% off. Nice. If you got iPhones coming out, let me know. I need to upgrade. Yeah. Yeah. The iPhone will make you more money. That's what I tell myself.
All right. And then Davis asks, what are some classic examples of positions or tasks that your parents can partake in? Also, does it matter if you pay them as a W-2 or 1099?
Oh yeah, yeah. So this one's pretty fun. Like it was pretty funny. I was when I went to the Zen Coast retreat last year, and then was it Jenny's mom and dad were out there too, and then they were just helping out, like getting all the so with that retreat that I had to put on, they were like cooking up food, warming up food, doing cleaning for us. So all those like ancillary things that you need to get done. I would say you can just run it like that. If you need them to take like photos and stuff or videos, you can also do that too. So any type of, I would say for our older parent generation, like anything that requires like physical labor, at least my mom and dad, restaurant, people, they just love moving around, having their hands and stuff around. So, just putting them to work around that, it's always the biggest use. Like, I got my little sister, she's got her art business, so stuffing in and packaging stuff, running at the UPS. So those are things in. And then W-2 or 1099, it's kind of up to you on that side of like how you want to do it. W-2 is the safer part, just because of legal implications of like how much control you exert over them. Contractor wise, less self-employment taxes for you on that side. Yeah. I guess Mike had a follow-up question too. Was like each business home office percentage must add up to less than 100. Yeah, it'd be a total of 100 if that's the case. So like if you had two businesses and you had $100 of like internet expense, they couldn't equal more than $100 each, or $100 total. I mean, sorry. So yeah, you can't write off more than what you pay out of pocket.
Then in his case, like if he says he runs two businesses, like is it easier just expense it all on one side that's actually just earning money and then just ignore the other one if it's not earning that much? Just to keep it simple.
Yeah, you
Like
can
if
do the same. Yeah, net and all in all adds up to the same. Yeah, it just depends on like how granular you want to get with it too.
Mhm.
Yeah. hmm hmm Cool, cool. Yeah. And then Davis is putting me to work tonight, man. Jesus, dude. So payment has to be reasonable for the jobs. Yeah, always reasonable. So like if you yeah, I would say if you're not going to pay someone else that same fair market rate, like it's not going to pass the IRS on that side either. So you want to make sure that, it's legitimate in terms of the expense that they do for you. And yeah, it's just, was that arm's length essentially. So you wouldn't pay a baby model $15,000 for one photo shoot. You may pay 400 bucks, 500, 600 bucks, whatever the going rate for that is.
But then if he also pays him as like 1099, then wouldn't that be the benefit of like they don't have to do all of the like the employer stuff and then it's whoever's paying the taxes will have to do it. And then if the
Yeah.
parents are in a lower tax bracket, then it's actually less for them.
Oh yeah, yeah, exactly. That's where you always get into you can get pretty creative if they're 1099. So you can save a lot in self-employment taxes on both parties if you know how to play the game the right way.
Mm,
Yeah, yeah.
love it.
Solid, solid.
All right. Jenny asks, so she used to travel around a lot. Can she expense half of the cost of the maintenance, say it's tires or brakes?
Yeah, so you expense so there's two so when you have a vehicle, there's two ways of how you can write off your vehicle, and also it depends on whether you have an S corp or a sole proprietor or Schedule C, or yeah, sole proprietor or single member LLC. And the big part is it always comes down to your mileage log. So this is another part where you get blown up under audit, is that if you don't have a mileage log, well, you need to start. So get Mile IQ, get QuickBooks, they all have mileage logs. And just pretend that you drive 15,000 miles total per year, and 10,000 of those miles for business, 5,000 are for personal. You will be able to deduct 66% of everything you used. So that's using the actual method. Now, if you, so like let's just pretend you had new tires, as thousand bucks for tires. You can take up to the pro rata amount of how much you use the car for business. So that in this example that I'm using, you can write off $666 of tires. So that's option number one. And then option number two is that you can write off the mileage method. I think it's like 70 cents or something. So if you drive like 10,000 miles, you write off 7,000 bucks. So you usually want to pick one and then stick with it. Otherwise, it's kind of like a headache to keep switching back and forth. For your taxes, it'll be complicated. So generally speaking, if you have a cheaper car, it's going to be better just to do the mileage method. If you have a more expensive car, you're better off doing the actual plus depreciation on that side. But those are general rules. It always comes down to your numbers, of course. But there's two ways to write off your car.
Speaking of car, um, I remember earlier you mentioned about like getting a car with a G wagon. I was gonna say G Dragon for the like the rapper.
Again, damn Catholic.
I like K-pop. G-Dragon. But like going back to the G wagon or
Demon
like
hunters. Yeah.
Demon Hunters, I know. But going back to like you having a car of a certain weight that you can use with the bonus depreciation and all of that. But then how about also Jenny? She's say she if she drives a Toyota and then say she buys it for her business, can't that also be a write-off itself? Like what's the difference between that one versus that the 6,000 pound and up one, like in terms of savings or how that works?
Oh yeah, so Section 179, that's like once again it's prorated for your business use. But so if you buy a 6,000 pound car, you would use the actual method. The actual method would be depreciating the car, and then it would be the gas, the mileage, the tolls, the insurance. If you buy a car that's less than 6,000 pounds and we're still using the actual method, you can take bonus depreciation. I think it's somewhere around 22, 23 grand this year on that vehicle. So if you buy like a $30,000 vehicle, you could take 23K off the first year and then depreciate the remaining 7 grand over the next 4 years. So that's just using the actual method. Now, if you want to use the mileage method, throw everything I said out the window and then just track your miles and times it by, 70 cents a mile. But you still want to have that mileage log. And the reason why like people always say G-Wagons or big vehicles is it's just the arbitrage. So let's just pretend that, this was actually pretty like prime when I grew up in Minnesota. Like you could always tell when the farmers had a good season. Like they all buy new trucks because no one's paying taxes. So what would happen is that you buy a truck, it's over 6,000 pounds. And then from there, say the truck's 80,000 bucks. If you just put down 1,000 bucks on it and you take a loan out for 79 grand, you still get the full $80,000. So on that side, you would get an $80,000 write-off using a 20% tax bracket once again. That's $16,000 of tax savings that you paid 1,000 bucks for. That's why people buy vehicles towards the year end also, because it's easier to justify too. So you're arbitraging $15,000. The government's giving you $15,000 kind of as a loan up front, and then you recoup it over 5 years. Like the answer is always the same over 5 years. But now this goes back to like general finance principle, right? You always take the dollar today, then a dollar tomorrow, right? So it's same thing for taxes. Like you want to use as much benefit as you can because I was been joking with my friends. I'm like, bro, you just die tomorrow. You never know. So, just live life to its fullest every day. Take all your tax dollars today, my friends.
Right, especially if you could take it and then invest and arbitrage a little bit of the difference, like why not, right?
Yeah.
It's
Hmm.
gonna be yours eventually, so arbitrage it and earn a little bit extra.
Yeah,
Yay.
exactly. Exactly.
Cool. Awesome. Let's see. Oh, so Jenny asked if the next call can be about the big beautiful bill. So we already actually had that about only a week or so ago. So Jenny, go check up our YouTube Subtle Asian Real Estate and then look up the video for that. So we just finished the webinar for that. So that one's up. But
Oh yeah.
yep. So also I'm gonna tell you guys cool news because I love taxes and like I actually no, I don't love taxes. I like to learn how to not pay taxes. So I'm actually starting also a new series coming up soon is about self-directed IRAs. That's gonna be another way for us to learn how to save money. And we talked a little bit about that, like the solo 401k or the IRA stuff, but like it's pretty much like you put the money into an IRA, you can do a Roth IRA, and then you decide what you want to invest into, whether it's real estate or other asset classes. So that will actually start taking place. So there's going to be like a 6 series. part with Madison Trust, and it's going to be kind of like, once a month-ish, similar to what we do with Tony. And then we're going to do that next week. It's going to be the first session. So September,
Ah,
same time. It'll be our intro to self-directed IRAs with Madison Trust. And that's our friend Dana, who we met at the conference last time. And she's really like, I learned a lot about it. And I think like it's going to be useful for us to learn more in detail about how these things can be used and then adding it on to like our repertoire of all these tax strategies. So I'm going to be excited for that.
oh yeah. Oh, Donna, by the way. Yeah.
Yes, that is right. So that will be
Yeah,
starting
yeah.
next week.
Nice.
Tony, so if people want to get in touch with you, how do they find you?
Oh yeah, easiest way is hit the website up, thecpaydude.com, Instagram, the CPA dude. If you want text, it's 254 CPA dude. So everything is the CPA dude on that side. And then yeah, that's where we post everything. I think I posted like I think I've been since we do so many events now, I actually like made Lone post or pin the events that we're gonna do. So yeah, that's where we'll be speaking at for all these things. I think I forgot to add this one in there, so I gotta get on top of it. But yeah, just find us on the CPA dude. Happy to help anyone out here and just guide them on the right way for tax savings. Um, yeah, I think don't check Facebook messages often, stay up to date.
Yeah, so
I don't know,
good
Annie,
one.
how do you do it? Yeah.
So we actually post all of our events up on our Facebook events calendar page. So you can always just like if you see something you like, just because we try to post these as soon as we've confirmed these topics. So you can just go and add that to your calendar. And then also if you are part of our newsletter on subtlerealestate.com, you can just go sign up. And then usually whenever we have these webinars coming up, we'll send like an email blast just to let people know of the event and then a quick reminder. But as always, we do record these sessions and then upload them to YouTube. And as long as you RSVP'd for the event, I'll have your email address and then we'll be sending a recording out within the next couple days. So you won't miss anything. We do have a lot of the topics from the previous year or last year. Davis, he's our attorney homie. He's done a lot of the webinars for us about LLCs. So go ahead and check those out on Subtle Asian Real Estate on our YouTube. So that's kind of it for the night. So thank you guys all for coming up. I'm gonna send this out maybe in like the next day or so. But hopefully I'll get to see you guys next week for the self-directed IRA chat. All right. Take care. Good night, everyone.
All right, peace.
Bye.
Thanks everyone.
Thanks,
Yeah.
Tony. Thanks,
Appreciate the
Annie. Good night,
time.
guys.
Yeah.
Thanks,
Take
everyone.
care.
Thanks. Bye.